everybody. My name is Michael DeJoy, and welcome to the Dash Trader Newsroom. And this time we're going to be talking about the banking crisis. Has the fear from the banking crisis already subsided? And again, my name is Michael DeJoy, and I'm joined here with my co-host, Jill Malandrino, global markets reporter from Nasdaq. Jill, how are you doing today?
Good, doing well. It's probably a good thing the quarter's coming to an end, Mike. It's been a crazy quarter.
Yep, it certainly has been, without a doubt. So let's just jump right in and talk a little bit about, the title of today's show, which is, has the banking crisis already passed? I mean, is there still threat, to the system? Are there more banks that are still teetering on the brink? Has a real workable solution been put into place? It seems like traders and investors have started to brush off the banking crisis already. I mean, what are your thoughts on the long-lasting effects of the banking crisis, and you know, has it already passed?
Mike, it's so interesting because what I can't wrap my head around is the velocity of how quickly this happened and how the market perceives that there's some sort of resolution there. I think part of it has to do, and one major difference from 08, 09 is structurally there's a difference, but we use digital assets and technology more so than we did in 08 and 09. And the news of this and the spread of it and the bank run was so fast because of
Yeah.
that. And certainly decisions were influenced by what was seen on social media. And 2, 3 weeks later, it seems as if the market is digesting it because when you and I were talking in February, Mike, the Fed was taking a much more hawkish posture, or they weren't hinting that there was going to be any shift in strategy. So I don't know if the market is viewing this as okay, regulators are focused on it. They are providing some sort of a backstop. It indicates or they perceive that the Fed's going to have a little bit more dovish of a stance. I don't know. They haven't articulated that, but the fact that they did 25 basis points in March versus 50, and you're hearing regulators come out, um, you know, pretty adamant at how they want to shift this regulation around. It sounds as if there's more of a resolution than there was in the beginning of March.
Yeah. Well, I mean, certainly some things have been done, but I mean, so I think that the two or three key changes have been that, number one, we were expecting a 50 or potentially even 75, basis point hike at the last meeting. We got a 25 basis point hike. The underlying root cause of the banking crisis is that banks have been putting depositors' money to work in bonds. And as the interest rates rise, those bonds invariably they lose face value. They don't lose the value of the bond if they hold it to maturity. But if people go to the bank and pull out their money, they have to sell the bond at a loss. So it's kind of created this situation where you have, if the Fed continues to move along its prime directive, which is to keep inflation under control, and I think that's the big story, is inflation under control? Is the Fed going to have to do more to fight inflation? Because it certainly seemed like the banking crisis was ignited by the uptick in inflation and then the kind of long-term loss that was created by people pulling money out of the bank, and the bank having to sell those bonds at a loss.
Yeah, Mike,
So
I would agree with you there because you have 12, 14 years where interest rates were so historically low, and then for them to go as high as they did, 500 basis points in what span of 9 to 12 months. Um, that is it's just such a major shift. But I think why it could be idiosyncratic to Silicon Valley Bank, they didn't have a risk officer there for 10 months. I believe it was
yeah,
March
that was crazy.
2022 to January 23. You don't hear about risk officers much. It's not the sexiest part in the C-suite, but you don't want to hear about them. If they're doing their job, these kinds of things don't happen. So I,
Yeah.
I think that was an issue. I mean, even from a regulatory perspective, I'm surprised we're even able to operate without one, but I'm not an expert in that.
They got the equivalent of like a Wells notice from the regulator that they did not have a risk department. They didn't have a risk officer. So they did get, like, I think it was from the FDIC, that they got like some kind of regulatory notice from stating that they were being warned that they needed to get a risk officer. And I heard that in the congressional hearings. But beyond that, like, that brings into question is, I mean, 10 months is an awful long time not to have a risk officer. you
Yeah.
know?
I mean, one of the main functions of a bank is to manage risk, right?
Yeah,
They're such an important part of not even the US banking system, but the global financial ecosystem. So, I guess silver lining is perhaps regulations will be tightened and they will be looking at management structure and risk profiles more. But Mike, I've talked to a number of folks, ironically on the cybersecurity side, but I guess they do a lot of work with AI and machine learning, where with all the AI that's available right now and with machine learning that has predictive capabilities, why are they not leveraging that in their risk modeling? Because this kind of technology can see some things that humans can't.
yeah.
So I think it'll be interesting to see what happens in terms of how risk modeling evolves.
Yeah, and I certainly wouldn't want to become overly reliant on it because, that kind of over reliance on kind of a hocus pocus risk management is exactly what caused 2008 banking crisis. It was kind of like, these credit default swaps and these credit swaps and these are risk. And the only people who use those kind of swaps are generally the risk managers. They are credit risk swaps, and they are very, very difficult to calculate. You almost need to have a degree in computer science and mathematics to kind of understand how these things work. But certainly, certainly it is helpful to have a chief risk officer. They did have, I think, four chief investment officers, but I guess they made some bad investments as well.
Mhm.
Yeah. So let's jump right into the next order of business, which is something that could be a systemic problem in the horizon or in the future, but I do kind of see um a little bit of a problem, from just the way that this kind of headline article read, is that dollar sign BBBY, Bed Bath and Beyond, which is one of these meme stocks that everybody seems to love to hate or hate to love, warn that their bankruptcy might be the only option left if their secondary offering fails. And it may just be that I'm from New York and I read this as a threat. It was almost like it came off like a threat to me that if we don't do well on our secondary offering, then we're going to go bankrupt, and then everybody who's holding our stock is kind of left holding the bag. Which is kind of what it is. I mean, if you could be read differently, obviously. But I guess the big systemic question is what is the state of the retail sector, and what is the state of the commercial real estate sector, given BBBY, is considered an ankle commercial real estate piece, and you can see them being shuttered all over the place. I mean, I was just in New Jersey, in I guess it was the Monmouth Mall, and I'm going to say like the American Dream Mall was at least is at least, I don't know, half empty, and the Monmouth Mall is about, I don't know, three-quarters empty. There's so many empty spots in big commercial real estate properties. Is that a potential problem going forward? And certainly this language with BBBY and Bed Bath and Beyond, which frankly I used to love the place, but certainly they couldn't hold on as a business model. So what are your thoughts on this announcement and commercial real estate and retailers in general?
Well, I think that Bath and Beyond is more of an isolated incident. And Mike, as you and I have always discussed, there's haves and there have nots that are going to perform well in the retail sector, right? And I think kind of another takeaway from this is they're doing an offering because they're unable to get that injection of cash or pledge for more funding from private equity groups. I think Hudson Bay was the one that they were with before, but especially in this environment, this heightened environment where cost of capital is so much more expensive, banks are clearly tightening up who they're willing to lend to. So I think it says something about the environment in general. But to your point, and real estate is the same way too. Um, um, family real estate is doing well. Personal real estate, but commercial real estate, in addition to hybrid work and figuring out what we're going to do with these spaces, is something that's a real challenge for the environment. But yeah, I would see that, Bed Bath and Beyond was probably a little bit more isolated than other retailers. I think what commercial real estate is starting to think about is how do we transition these spaces for the current economy and moving forward? Do we think about turning them into housing? Do we think about turning them into experiential type of places? Because this trend has been in place forever, but your older department store anchors like a Macy's, a JCPenney, a Dillard's, that sort of thing, that's really not where customers are gravitating to. So I'll be curious to see how these big box stores and department stores, how that property is converted going forward.
Yeah, that's a very interesting. I mean, we see how, in New York, we're seeing how this, New York always seems to be the archetype of the test case of how business adapts, right? So, you and I both started working in the Wall Street financial district area back in the late 1990s and early 2000s, and there were literally 40,000 more employees and workers working in that area. And for the most part, that all of that massive business district got converted into retail space
Hmm.
and housing, right? I mean, it became residential. I think 10 Wall Street and 10 Broad Street and 40 Wall, a lot of these places, 40 Wall is still actually a commercial space, but
Hmm.
many of them became residential.
Yeah.
And this is exactly it. It seems like people are seeking out more of experience type shopping, not department store type shopping. They're going for things that are kind of more experience orientated, and it's not just residential. It's also kind of like the Airbnb type places are being popping up. People are buying apartments and real estate. But the question is whether that will work outside of a place like New York City, in some of these places that were just kind of massive malls.
Yeah. Well,
Um,
I mean, New York City is such a specialized boutique real estate environment, if you will. So, for example, I was downtown a couple weeks ago, and I don't know if you're familiar with the way the New York Stock Exchange is situated. There's the front entrance, but the back entrance is One Wall Street, and they
yeah,
have converted that entire building into multi-million-dollar apartments. You need an
yeah,
appointment to get in, so
yep,
you can't even just go and look at them. So, that might pass in New York, but we have such an affordable housing crisis in everywhere else. So I don't know what those conversions will look like. But to your point, even before 9/11, and I would say this was not even just because of 9/11, but all the businesses downtown moved to Midtown because Midtown buildings converted and had the technology in place as the industry was getting more digitized and with electronic trading and so forth. So that was a trend that was in place. So commercial real estate
there's
operators,
connectivity. Yeah,
they do, they can predict some of these trends or you know, learn to adapt to the environment.
yep, without a doubt, without a doubt. So some great points. So I just want to summarize some of the points. Bed Bath and Beyond is kind of an outlier. It's kind of has it's suffering from its own problems, and that it was having trouble kind of raising capital from the usual suspects because of kind of the drying up of liquidity. So, being as that it is such a popular meme stock and that so many people like to trade it, the secondary offering becomes a viable solution, which is a great which really does make sense in terms of in terms of this specific situation, and it is kind of a unique situation as many of the retailers go. And then that brings me to my final item to talk about together today, which is I'm sitting down, I'm working on the newsletter for the month, and I'm also looking at what the Fed is expected to do for the rest of the year. And I don't really, I mean, for me and from what I can glean from reading, various different analysts and various different research papers, as well as what the Fed themselves have said, it seems like the Fed is kind of intending to continue to raise the minimum, which is a quarter basis point, pretty much every meeting this year, which is like the minimum they can do to kind of fight inflation and keep the system intact. And what are your thoughts?
Well, I know I wouldn't want to be in Powell's shoes, that's for sure. But we don't have a meeting in April, which is interesting because we have a slew of earnings coming out then. It'll finally give us an opportunity to perhaps shift gears a bit and focus on fundamentals a bit. I would agree with you, and you and I have been pretty consistent with our messaging. The Fed has been clear telegraphing what their policy strategy is, and they have not changed tact with that. So I would agree with you, Mike. Whether they um, raise 25 bips, don't raise, I don't foresee cuts or anything until they get the data points that they want. I've had a number of strategists on the show. They think 2% inflation rate is way too ambitious for 2023, perhaps 2024, maybe 3.5 to 4%. But I really don't see them changing tact until they signal that they will.
Yep. So I think that we're in line there. I have one more item, and this is just kind of a question. There was this recent meeting between the I don't ever like to say his name is, I guess it's the president of China and Putin in Russia, that they are going off the U.S. dollar standard. Now we've heard this talk for a long time. The saber rattling's been going on a long time, but it looks like they might have Saudi Arabia on board with this as well now. So what are your thoughts on what the effect would be of the of some kind of actual, I mean, true action to go off the dollar standard? Because I mean, obviously here in the United States, the reason we benefit from so much credit is because we are the world standard as far as currency goes. So do you think that this is more than just the normal saber rattling that we've heard for 10 years about going off the dollar standard?
Well, you know what, Mike, that trend has been in place for the last 10 years where you're seeing a decline in dollar reserves and actually an uptick in gold. I wouldn't view it as um, not fatalistic, that's not the right word, but it's not even just China, Saudi Arabia, Russia. There are other, even emerging economies are just looking to diversify their base. So I think it's probably a little bit more than that. The obvious interpretation, the obvious knee-jerk reaction is to try and put those theories together where Russia, China, and Saudi Arabia. But I mean, this diversification has been happening for the past decade. To your point.
Got it. So it's just a continuation of the trend and just more saber rattling, and they just happen to be together in Moscow talking about other things. So the saber
I
rattling continues.
Yeah, but if we take a look at the trends and the data that comes through, that has been in effect. In terms of diplomacy and politics and strategy, I can't even pretend to
Yeah, me
figure that
too.
out.
So we'll leave it at that. But this is the end of the first quarter. It's tomorrow marks the end of the first quarter, and then in April we start earnings season. So I look forward to seeing you in our upcoming newsrooms, and then we get to start talking about earnings once again.
All right, sounds good. Have a great rest of
T-
the week. Take care.
Take it easy, Jill. I'm going to jump to the charts here, so just give me a second as I switch my projector here. So we're going to move forward, and we're going to do some market analysis. And we always do our market analysis with our DAX trader chart. So, all right, so we should be looking at my DAX trader. So the first thing I'd like to talk about in by going through the charts is basically where we are in the market. I mean, I'm looking at deeply overbought readings on the CCI. So now here in the newsroom, because we're kind of dealing more on a macro time frame. You can see that we had the banking crisis, the sell-off from the banking crisis, the resolution of the banking crisis, and then of course now we're kind of back taking out the prior high on the S&P. Or this is on the QQQ, but on the QQQ we've taken out the prior high. We've kind of gotten into 1, 2, 3, 4, 5, 6. Every time we've gotten into this area on the CCI, we've basically had a precipitous sell-off. I mean, you could see here, sell-off. Here the sell-off wasn't that severe. Here we had the big banking crisis sell-off. This was the beginning of the year, the end of last year sell-off. But needless to say, anytime you get an overbought region on the CCI getting above 100, and this time we've done it, twice, and there's also a divergence in there as well. That usually does not bode well for the markets. Now, I also like to go to the main leading stocks like Apple. Apple is way stronger than the market, and certainly if Apple turns, okay, so shall turn the market. Tesla not showing as much strength as it once did, but certainly Tesla has held up fairly well. It's not participating with the market rally quite as much as it used to. In fact, it used to lead the markets. Now stocks like Microsoft and Apple are doing so. Certainly Nvidia, has been a beast. Obviously, those who trade, have watched this incredible run. This, I would call this the AI rally. Nvidia has run from 120 in October all the way up to 273. But we're starting to see signs that, after that beautiful buy setup, that Nvidia is running out of steam on what would be the AI rally. Last but not least, I'm going to go to GLD. Gold is catching a bid because of exactly what Jill and I were talking about last, which is that gold is now getting the benefit of all of the diversification of various countries into other countries. And I would say that gold's getting a bigger benefit than Bitcoin, although Bitcoin GBTC went from 750 all the way up to $15 in this latest run up. But the CCI on GBTC is looking pretty bad, like Bitcoin's about to give up the goat. Needless to say that we got silver, SIV. Okay. Silver has made a tremendous run up, hitting $30. This is on the ETF. The silver ETF has hit 30.76. Tremendous run up on silver. Silver generally tends to outperform gold when it's in a bull market and underperform gold in a bear market. And then, of course, we have USO, right? So you have USO or USL. Okay, you got USO, USL. So you got a nice run up on USL, right? USL is the 12-month futures contract. So let's take a look at this on the weekly. Let's actually go to USO because I think you could see this a little bit better on, just try oil. It's the ETN. But we got a deeply oversold reading. I have to go back. Let's go data config. Let's go back to 2020. Bang. So here is, if you see, we have we're getting a very long-term buy signal on oil here at 26.27. And oil, if oil starts to go up in price, that is really not good for inflation overall. And again, we're going into the summer months where you have more travel, and that's cyclically, now is the time to buy oil if you expect a cyclical move up in oil for the summertime. So this would be the summer cyclical buy time on oil. So we got all of that going on, and let's see which one else that we usually go through. Ethereum also caught a bid on Ethereum. It's not quite as pronounced as the move up in Bitcoin, but certainly Ethereum, having bottomed out around 5. This is ETHE, bottomed out around 5, and it's kind of almost in the double spot. Although it's also giving that deeply overbought reading, possibly some bearishness coming into the ETHE rather, on Ethereum. So they all benefited, but I mean, obviously they got crushed in the big sell-off last year. They kind of bottomed out, I would say, at the end of December, and then since then they've been trying to put in a bottom. But remember, markets tend not to double. They tend to not bottom. They tend to double bottom. So with that being said, just be careful on all of it. The one that we really need to watch is the IWM, which is the Russell, which really did not bounce with the rest of the market because they are very, very oil interest rate sensitive. So this is the Russell 2000. The IWM, and very small to almost no bounce, getting a little overbought now, but certainly the Russell is still showing that the Russell is really showing the threat of additional Federal Reserve interest rate changes, interest rate hikes, as you would expect it to. So I'm going to jump right now to expand this. Hold on one second. All right, everybody, stay up to date with all things DAS by signing up to our monthly newsletter. Simply fill out the form at the bottom of our webpage at www.dastrader.com. Subscribe to our YouTube channel, DAS Trader TV. We have a whole host of new videos coming out on everything from configuring DAS to lessons on trading. We also have a great new website, learningdaytrading.com, that we're contributing content to. So you can follow us on social media at Dash Trader, and you can check us out, www.linkedin.com. There's a kind of extension for Dash on Twitter, Facebook, and on Instagram. Thank you so much for joining us here at the Dash Trader Newsroom. This is Michael DeJoya signing off, and trade well, everybody.